Investors had a nice snapback rally today after experiencing heavy losses yesterday. In fact, the S&P 500 was up over 1% today. It was the first time it was able to accomplish that in a few months. It was largely as a result of improvements in the consumer confidence number, but we also saw some healthy boosts from earnings that were being reported throughout the day. In fact, after the bell tonight, one of the biggest fish out there, Apple, came out with their earnings announcements, and shares are trading up about $5 per share after hours. So we'll talk about all of that and see how it affects our posture. There were a couple of changes that we need to identify tonight, and then we'll get into our trade application example from a stock in the overperforming or outperforming NASDAQ that's setting up as a nice bounce candidate. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's January 28th, 2020. First of all, if you're new, welcome aboard. Remember to go to YouTube, click subscribe. While you're over there, check out our description area and sign up for our email distribution list. We're also heavy users of Twitter. I would encourage you to follow me at Brandon Van Zee. And I do appreciate those of you that click like and retweet it whenever we post these videos on Twitter. Lastly, we have a presence on Facebook. Feel free to join our group at the web address embedded in the link in front of you. All right, let's go ahead and get started here. As you can see, I've got chart 4D pulled up here in front of us. Now, I don't normally start with this particular chart, but I like to do so whenever we have a day that is a little bit more of an extreme day. This particular chart here will kind of give us a sense of how often these types of days happen. You can see right here that the most recent bar kind of in the middle of the screen is green, and it's reaching all the way up to this blue line right here. So as you can see from the label, the blue line means that's a 1% move. Now, if it's above the zero line, like it was today and painted green, that means it's a positive 1% move. You'll notice that yesterday was a red line there that came down below the blue line on the underside. And of course, that means it was a minus 1% day yesterday. So we've had a little bit more of extreme price movements here. A lot of it, of course, is a result of what's been going on with the coronavirus in China and how it's spreading throughout the world. And I think that the death toll is up over 100 now and spread to up to 16 different countries the last that I checked. So I imagine that's going to continue to kind of command attention in terms of headline risk out there. But the market is starting to get maybe a little bit more comfortable with it, at least if you are to believe the price movements we saw today to the upside. Nonetheless, the last time that we had back-to-back 1% days where we went from 1% down to 1% up would have been back here in August of last year. Actually, it was this one right here, right at the end of Nope, that one was only down 0.5%. I'm sorry about that. It was this original one that I was pointing at right here. It would have been August 23rd. We had a really big sell-off there, and that would have been a Friday. And then the following Monday, the next trading day, we were up over 1%. And that was right at a time where we were finally starting to establish some sort of a bottom. Some of you will remember that August got a little bit more chaotic. In fact, you can see that's one of the nice things about this particular chart is you can kind of just get a sense by a quick glance where we have more volatility and where we don't. And you can see kind of where I'm circling right in the middle of this chart right here. We had some really tall bars to the upside and some really dropping bars to the downside, telling us that we had some more extreme price movements. But the good news is when we had a back-to-back 1% down rate and turn around to a 1% up, we did start establishing a bottom there, and therefore maybe there's a little bit of optimism out there. You know, I think right now we're all kind of treading cautiously, but it is good to see that the market wasn't willing to just completely roll over in this case, and there are still folks that are out there searching for good bargains when it comes to high quality stocks. So anyway, a little bit more of an extreme day today. Our first 1% move since going way back here to the fall. Let's get back on track now with the kind of normal chart routine that I take you through. Let's go over here to chart 4B. This will be our foregrid to give us a sense of how are all of our different indices here in the United States trading, at least from an equity perspective. And there are some differences. Sometimes you guys might wonder, why do we look at all four of them? Aren't they always the same? Well, today's a good case in point where that is not the case. You can see we have some differences in front of us. In fact, one of the more noteworthy events here today was that we put in a weekly bearish posture on the S&P 500 for the first time since going back to this period right here in kind of the beginning of December. You can see that this chart is largely green. The only time prior to today that we had any pink was just for a couple of days back here. So this has been a runaway freight train to the upside. The trends are strong. Obviously all trends eventually end, but there are a lot of good opportunities along the way. So a lot of us are wondering, is this going to lead to anything more significant? Is this kind of the moment everybody's been waiting for the last 11 years as the market's kind of seemingly gone straight up? There's a lot of people that are kind of looking at the market in disbelief and expecting some sort of a moment where the rug is pulled out from under the equity markets. That's not my sense of things. Now, were we due for a pullback? Absolutely. We don't go straight up forever. It's just that's a fairy tale. It doesn't happen. You have to earn your way to success in the stock market, and that's usually by taking risk. And a lot of times you're going to feel uncomfortable at times in the market. Right now, we happen to be in a little bit of a seasonally weak period. I think David has mentioned before that up until about February 11th or thereabouts, we have a little bit of bearishness there. So we're kind of grappling with that along with, of course, the coronavirus and trade talks and any negative earnings announcements that might be coming out or what have you. So don't be surprised if we have a little bit of further weakness here in the next few weeks. But is this the end-all, be-all? Is this the big one everybody's been waiting for? Is this the moment in time the market rolls over and heads straight into a bear market? That's not my impression of things. Again, I mentioned the intro, the consumer confidence number. You can look at a number of different economic indicators, and if you believe the numbers, we happen to be in a very strong economy right now, and it is possible that the markets themselves are overvalued, and we kind of need to correct a bit for that, where prices have gone up too far in the past, and therefore, we might not have the rosiest, performances going forward from this point. But you typically don't see the stock market go straight down for like a 20% bearish move or anything along those lines if you have an economy as strong as it is right now. Obviously, anything's possible, but we all have to kind of set our expectations. And my expectations right now is that this is not the last hurrah. This is a momentary pullback in an otherwise very strong longer-term uptrend. You can see that despite today's pink background there that denotes that we now have a weekly bearish posture, and that happens, remember, when this green line on the market forecast indicator falls below 80, and it just barely did here today. You can see that the reading on the green line is currently 77.96 and falling. So it fell out of that upper reversal zone and now has a weekly bearish posture. It's not a strongly bearish posture. That you can see actually exists down here on the Russell 2000. You can see that there's a slight difference in the shading of the pink down there in the lower right-hand corner, whereas yesterday it was that lighter pink color where it would have been similar to the S&P 500 today, where we would view it as a weekly bearish posture. Today, we now actually go to a strongly bearish posture on the Russell 2000, and that is because the green line didn't just fall out of the upper reversal zone in the Russell 2000's case. It actually came down here and is now below 50 and continuing to fall. You can see the green line, or the intermediate line on the Russell 2000, is at 45.42 and falling. So it's kind of interesting that we have 4 different charts here in front of us, and we actually have 3 different postures. That doesn't happen very often. We've got a strongly bearish posture with a small cap Russell 2000. We've got a weekly bearish posture on the large cap S&P 500 and the large cap Dow Jones Industrial Average, but we maintain a strongly bullish posture on the NASDAQ Composite. Now, despite the postures that are basically being spit out from this market forecast technical indicator, which is not perfect, it's a technical indicator like the other 200 plus technical indicators that are out there. You can find it on the Thinkorswim platform, but there is a little bit of some cracks in the sidewalk, so to speak. There's a little bit of breaking that's taking place as a result of some of the movements we've seen in the last week or so. But here's the positive side of it. If you're looking for kind of the light at the end of the tunnel, I think there were some interesting bounces that were taking place today. Some of you are familiar with the acronym CAHOLD, or a close above the high of the low day. And you can see that that really did represent where we stand on the S&P 500 and on the NASDAQ composite here today. So the most recent important low that we experienced was just yesterday in both of those cases. Today we closed above the highs of yesterday's candles. So if you're looking for an excuse to look for a bullish bounce, that's often a good sign right there. And I'll add to add to that further, the fact that it's bouncing off of an important support area like the 30-day moving average lends it even a little bit more credibility there. So you'll see that yesterday the S&P 500 came right down to the 30-day moving average. If you needed it to bounce, it was do or die. It's now. And the market responded positively in this case. There's still pent-up demand for shares of stocks out there. Same thing happened with the NASDAQ. Came down to that 30-day moving average yesterday, bounced right off of it here today. In fact, you'll see that in both the S&P 500 and the NASDAQ's cases, right here for the S&P 500, it was on December 3rd, and right here it was also December 3rd for the NASDAQ. It touched the 30-day moving average on both of those indices on that day as well, and of course you can see the rest is history. We had firm bounces immediately after touching the 30-day moving average. Is that going to unfold exactly the same way with this touch of the 30-day moving average? Hard to say. There's certainly evidence on both sides, both camps, bears and bulls, that could make a case. But generally speaking, the trend is your friend. And the trends right now are still largely bullish, even if some of the individual technical indicators are starting to give us a little bit of bearish warning signs. So we'll keep our eye on it, but generally speaking, if you're somebody that believes that price is king, you're usually going to be rather optimistic as long as price is above a rising 30-day moving average in this case. And for 3 out of our 4 charts here, we can make that claim. The exception to that is the Russell 2000, which despite today's bounce is still below that moving average right there. So anyway, I should also point out that the NASDAQ composite did lead us here today. It was up 1.43%. So a very nice move there out of the NASDAQ composite. Those of you that have been kind of following sector movements more recently, maybe we shouldn't be entirely surprised by that. In fact, let me take a moment to pop on over to the internet. As always, thank you to those of you that clicked like and retweet for the last time we did the video here. But also, while we're on the internet, wanted to show you the most recent version of the sector selector that I produce on Friday evenings. So this is a couple of trading days old at this point, but you will see that technology remains number one. They've been number one for basically every week for the last month, every week of this new decade, I guess you could say, because really they took the number one slot here that first week out of January and have maintained that strength all the way along. Some of you saw me tweeting about the utilities over the weekend. And they're worth mentioning as well. In fact, I talked about the utilities in this presentation a week ago because by then they had already gone from number 7 up to number 4, but they weren't done there. Utilities had another stellar week last week to improve their prospects even further. Utilities have gone all the way up to the number 2 slot on the sector selector here. So really, really impressive move there out of a fairly quiet corner of the market. Not a lot of people like talking about the utilities, get excited talking about the utilities, but every trade has its moment in time, and right now the utilities are shining. Part of that is the interest rate sensitivity that is attributed to the utilities, and I'd also mention, as kind of an honorable mention here, real estate. Yes, they were only 5th out of 11, but they have improved dramatically. It wasn't too long ago. In fact, the first week of January, the REITs, or real estate, was dead last. It was 11th, and then it's gone all the way up to the 5th slot in just 4 weeks. So those interest rate sensitive areas are working right now in addition to the high-tech world with those technology stocks. And at the bottom, it's kind of the same old story, energy and materials struggling on a relative basis versus other sectors that are out there. Another thing I wanted to point out real quick here is that the Dividend Aristocrat list came out since the last time I was with you guys. Standard & Poor's is in charge of the Dividend Aristocrat list, and it's an annual rebalancing. So it's usually at the end of January when the new stocks are announced, and any that need to be kicked out are also announced. And so I did put together this blog post here. All of you are invited to see it. Some of the stuff on our website is locked down for only premium subscribers, but this particular post is in the dividend growth investing category of our blog. So if you just come over here and click on blog on our website, you'll see a recent post that's just called 2020 Dividend Aristocrats, and it kind of talks about some of the stocks that were added, any changes from stocks that were kicked out, and then also gives you all of the ticker symbols of the 64 current stocks that are on that Aristocrat list. So make sure you're checking that out as well. Also, before I forget, I'll try to remind you of this again before I close out here tonight, but there will be no market outlook video tomorrow. I'm going to be out of town, and so we'll take a day off here tomorrow. David will plan on being back with you on Thursday, as far as I know. So anyway, just be aware of that slight change there. Anyway, let's go ahead and get back on track with a few of our other charts that we like to look at here. Let's take a stab at the three green arrows chart here, kind of get a sense of where things stand right now. And as it stands, we actually have only one of the charts that is decisive. And what I mean by that is when you have a background color, you have either three green arrows and the background color is green, or you have three red arrows and the background color is pink. Right now, we only have one background color, and that is pink. Right here for the Russell 2000, it does continue to have three red arrows. But in the case of all of the other charts, we have a mix of green and red arrows. That was not the case yesterday. Just yesterday, the S&P 500 and the Dow Jones both had three red arrows, but with today's nice snapback rally, we actually closed above that rising moving average on both the Dow Jones and the S&P 500, and therefore we have at least one of our green arrows back. So we're not off to the races by any means, but a positive sign nonetheless that we're finding a little bit of stability, and value hunters are out there trying to scoop up some pullbacks whenever they have the opportunity to do so. So right now, not a whole lot to report there other than the Russell 2000 does appear to be kind of the weakest link of our equity markets in the United States right now. All right, let's go ahead and do a little bit of 12 grid analysis. Let's pop on over here and start with 5A. This is the asset class 12 grid. So as we get started here, it's worth pointing out the upper three. So in the upper left, you see three charts there. We have SPY right here, EFA, which represents the developed foreign stocks, and then EEM, which represents the emerging foreign stocks. It's been a while since I've been doing this presentation that I can say that we have bearish postures on all three of those charts. We've gone through a very bullish time period in terms of at least the posture setting mechanism built within the market forecast indicator. So it's been, I'd go as far as saying it's probably been months, several months, since we've had all three of those charts pink at the exact same time. Obviously, there's a lot of concern around everything that's going on with the coronavirus, and whether it's spreading to this country or that country, and how it's affecting shares of a lot of those companies I talked about last week when it was first kind of emerging. The casino companies, and the airlines, and the online travel agencies, and everything else that you can think of that might get affected. When people are kind of locked down and quarantined. And you can see the emerging market stocks are really taking it the hardest. Now, of course, that makes sense. Emerging markets is where China is right now. It's a little bit suspicious, I guess you could say, or you might not think it in advance because China represents the world's second largest economy, but from an investment standpoint, they are still considered an emerging market at this point. So that'll eventually change, I'm sure, but right now that's where they put China. And China is going to be probably the most influential company, or country, I should say, within the EEM or the ETF that tracks emerging market stocks in general. So when you see a big drop off like this, you can probably blame China in this particular instance, but they're not alone. China serves as the bellwether for emerging markets, but without a doubt, the others will generally follow suit. And we have to remember that airlines are not as free to travel across borders right now as they once were, and so there is a possibility of the global economy starting to grind a little bit more to a halt. We'll see how fast we can get past this healthcare scare that we're going through right now, but we do want to make sure that we recognize that it's not all roses out there. There are legitimate worries out there in terms of not just healthcare and safety, but what we study here in these videos, which is the financial markets. In terms of other interesting moves that we've been seeing recently, oil has been talked about a lot, so I'm not going to say it's kind of been forgotten, but it is just worth emphasizing more than anything else, because it was really just about a month and a half ago or 2 months ago when oil looked like it was finally kind of putting itself together again. Let's say you lost your job and you've been out on the job market for a year, and you finally kind of get the motivation to put the suit and tie on and get in there and start shaking hands again and kind of presenting yourself to the world. That's kind of what it felt like with oil here late 2019. It's like finally we're getting some bullish price movement that could lead to something legitimate. And then this happens. It's like every single time you want to trust the bullish move in oil or any sort of bounce that you see along the way, and it just ends up gutting you. And they twist the knife awfully hard there. So you can see that USO has gone down significantly in just the last month. And at this point, we are getting those oversold cluster signals. So who knows, maybe we're due for a bit of a dead cat bounce. It was up 1.35% today. We use USO as our proxy here. But given how much it has already dropped, this is not much of a dead cat bounce, only 1.3%. So I don't know how much I would trust that bounce at this point in oil. I think I feel maybe a little bit more comfortable trusting the bounce in stocks in general than I do with oil right now, but only time will tell on that one. We did have a really nice move there in high yield bonds today. High yield bonds, you can see, are still in the pink as far as the background color of the chart. So we do have a weekly bearish posture there. But that was a nice looking candle that we saw out of HYG here today, one of the bigger ones on the board over the last 3 months. So we'll have to keep our eye on that. Remember, high yield bonds tend to do a bit better if oil prices can bounce, because a lot of the corporations issuing kind of junk debt are some of those oil and gas exploration and production types of companies. And so if oil prices can stabilize and go higher, we might also see a nice little bounce out of the high yield bonds. And remember, not all bonds are created equal. TLT has been in a major breakout move here for the last couple of weeks. It was down pretty significantly today. It was down 0.78%, but it has been breaking out to the upside in a big way at the exact same time that junk bonds have been going down dramatically. Obviously, they're on two different ends of the spectrum when it comes to risk, but I think sometimes people have the tendency just to think of bonds as one big cohesive unit, and that is certainly not the case. There are opportunities that exist out there depending upon circumstances, and right now it seems that high yield bonds are kind of acting a little bit more like oil stocks than they are acting like government bonds as an alternative. All right, let's go ahead and take a peek here at our next 5 grid. In this case, let's go ahead and look at our U.S. sectors. Kind of address this a little bit with the sector selector already, but just to kind of point it out one more time, we've got 3 charts on the board that are green. We have technology that had a wonderful bounce today. XLK was up 1.91%. We have utilities down below here. They did reasonably well today as well. They were up 0.41%. So they weren't the greatest mover on the board by any means, but the fact that this very defensive area that had held up as well as it has in recent weeks continued to track higher, even on a kind of quote-unquote risk-on day like we experienced today, is rather impressive. And then we also have real estate kind of holding up its end of the bargain. And of course, those are the three areas that I mentioned on the sector selector, with technology being number one, utilities being number two, and real estate kind of deserving of that honorable mention. Yeah, they're only ranked fifth, but they have gone up from the 11th slot in just 1 month's worth of time. And this kind of 12 grid view that we have here is kind of proving that out, why that is the case. In terms of areas that are looking a little bit more nerve-wracking, take a look at the financials. Now remember, financials are interest rate sensitive as well. It's just that they're opposite interest rate sensitive to the utilities and REITs. Usually if interest rates are falling, utilities and REITs do well, financials do poorly on a relative basis. And that is what we experienced here recently. In fact, we talked about the financial sector in my dividend growth investing class earlier today. So if you were interested in the two stocks that we put through the gauntlet in our deep dive analysis for that dividend growth investing class, of course, if you're a premium member, you're invited to go check out that recording that is now posted to our calendar. But that's been one area that's been out of favor. So if you are more value oriented and you're looking to pick up some shares that have sold off, maybe you'll find that in the financials. Now, we look at it in my dividend growth investing class because we're long-term investors in that class. If you're a shorter-term, more active trader, you're probably not going to be wanting to looking at the financials direction. Right now, the trend, at least the near-term trend, is in a bit more jeopardy. You will see here that the financials 30-day moving average has now turned lower. Right? This is a big move the financials had made since November, but just here in the last 48 hours, the financials have turned from a green moving average to a yellow moving average for 1 day, and now for the last couple of days has been a red moving average, signifying that price is now below a falling moving average. And that's the first time we can say that in several months for the financials. We also have some problems here with the materials and energy stocks. Energy stocks, of course, it makes sense with oil prices struggling the way that they have in the last month. Oil and gas stocks themselves are going to struggle in that environment as well. And that is certainly the case here with XLE. That looks pretty awful. Obviously, they have oversold cluster signals just like a barrel of oil does right now. So who knows, maybe a dead cat bounce is a possibility. But right now, the trend is certainly out of favor when it comes to oil and gas stocks. And then the same thing can kind of be said for the materials. It's just not as extreme. In fact, you can look at the intermediate readings to kind of get a sense of the differences there. The intermediate line on the materials ETF here is 22 and falling. That is a strongly bearish posture, but I mean, it's a whole different ballgame when you're talking about the intermediate line on the energy stocks, 5. Remember, it only goes to 0. So you're right down there about as low as it can get. So that's how out of favor oil and gas stocks have been here in this most recent move. All right, so that brings us to our trade application example for the day. I mentioned earlier that the NASDAQ is the index right now that appears to be outperforming the other areas. So I wanted to take a look at one of the key NASDAQ stocks out there. By the way, here's Apple. Apple was already bouncing today. It was up 2.83%. That was before they announced their earnings after the bell tonight. They have now gone up again. If I come over here to Apple, you can see that after hours, it looks like they went up about $5 per share. So they closed the session at about $317. They're now trading at about $322. So we'll see if that holds going into tomorrow's open. But obviously, if it does, that's a very positive thing for the stock market in general, as Apple is the world's second largest publicly traded company. Of course, Saudi Aramco now takes that crown. But nonetheless, a very influential and important stock, especially here in the United States. So hopefully that gives us some positive vibrations going into tomorrow morning's open for the stock market. But I actually wanted to talk about a different company here in our trade application, and that's Lululemon. This is a stock that seemingly people have wanted to hate over the years. I can certainly understand the reasoning behind that. This is a company that sells yoga gear, yoga pants, yoga wear. I don't know. I can't say that I've spent too much time in a Lululemon shop myself, but I do know that they are very popular, and there is definitely something to it. And their stock has just done phenomenally well over time. In fact, this is one of our holdings in my top-down trend trading class. But that's not the reason I'm looking looking at it here today in the video, what caught my eye here tonight was that we have what's known as a bullish near-term divergence on Lululemon. Remember, for that particular trade signal using the market forecast, you're going to want to focus and emphasize the blue line. So again, it's called the bullish near-term divergence. And the blue line, remember, is the near-term line. And what we're looking for on something like that is this scenario where we have a trough right here. So kind of look for the lowest point of the blue line right here. That's in the lower reversal zone. And that would have occurred for Lululemon on January 17th, just a hair below that 20 level right there. So just barely got into the green. And then you have a second trough over here, which is slightly higher. And that just occurred yesterday on the 27th of January. Now, at the same time, when you look at the candlesticks that were associated with those two levels on the near-term line, let's look at the one on the 17th. That's this candle right here. And then if you look at the one yesterday, that's this one here. So we have a situation here where price went down over that time period, but the underlying indicator went up, right? We have higher lows on the near-term line, we have lower highs on the price action itself. So that is telling us that despite price looking like it's quite weak right now, the underlying indicators that not everybody is looking at is telling us that there's something a little bit more bullish taking place below the surface that might be worth paying attention to. And of course, Lululemon just today gave us this nice bullish posture. That's why the background color of this chart 3A is blue. And we also have a hold signal here. In other words, close above the high of the low day. Yesterday was the low day. And just like the S&P 500, it's bouncing up and off of that rising 30-day moving average. So what I thought we would do today is just a simple swing trade. We're going to do a 1-for-1 reward risk ratio here. And what I'm going to do is I'm going to put my stop loss 2 pennies below the low of yesterday's candle, since that was the most significant recent low candle. And the low price yesterday was 231.84. So I'm going to put my stop loss at 231.82, 2 cents below yesterday's low. Now, if I want to, do a 1-for-1 reward risk ratio here, let me show you what the results suggest. So the current price of this stock is 239.35. If we put our stop loss at 231.82, when I subtract those two numbers from one another, that means that we have risk per share of $7.53. So that's the per share risk that we're dealing with there. So if we take that number, $7.53, and add it back to today's current price of 239.35, it shows us that our upside price target in this case is at $246.88. This is a trade that we implement quite often in my swing trading classes. For those of you that want to learn more, I teach that particular class on Wednesdays. I will be here tomorrow morning, so that class is still on. Feel free to join me for that class if you would like at 11 a.m. Eastern Time. But anyway, as you can see, the $246.88 price target would be just a hair below the top of this candle right here. So in other words, if there is a big seller that set up shop right there at 247.51, and that's the reason the stock struggled to get past that level going forward, we're not asking our trade to get up and through that candle. We just need it to approach those levels again. So perhaps that'll end up being a benefit to us there as well. So kind of think of it as a swing trading bounce setup on a stock that has already been trending for quite some time, but we kind of got a new reload the gun situation here as it's pulled back in the last week or so. We got a nice bounce here today with the hope that maybe this bullish near-term divergence can push us back towards those prior highs that we saw here a month ago. Okay, so let's go ahead and place that trade. I'm going to right-click on the chart. I'm going to go ahead and come down here to Buy Custom with OCO Bracket. One cancels other bracket. So I'm going to click on that. That loads up our trade down below. Obviously, you're going to want a position size for whatever your account suggests. I'm just going to leave it in there with the default 100 shares here, since this is just for educational purposes only and paper money. But I do want to click this little pay-per-click icon right here to kind of lock all of those together. I am then going to come over here to the right-hand side, and I'm going to type in 239.35, which is the current price, or where it closed here today on Tuesday afternoon. I will just put this in as a limit day order, so that will be good for tomorrow. So that's the day that it's associated with, since we're after hours here tonight. I then, on the second line, or the first one in pink, I need to change that number to our upside price target, in this case 246.88. I do want to change that to a good till cancel order, so that way it allows it to work as long as it's needed. Directly below that good till cancel order, I'm also going to click that drop down, click good till cancel there. That one is associated with the stop. So our upside price target and our downside stop are both going to be good till cancel orders. And then finally, on that last line there, we do need to type in our stop price, and that, as I mentioned before, is 231.82. Okay, now after that's all set up, I'm just going to click confirm and send. Just going to glance at this with my eyes, and you can see right here in the middle it talks about base plus 753, base minus 753. That's the one-for-one reward-risk relationship that I was mentioning before, and that's effectively what I am hoping to accomplish with this particular trade. So I'm going to go ahead and send this in, and we'll see if we can get filled first thing in the morning. All right, well, thank you for joining me here yet again. Nice snapback rally in the markets today. We also had a nice little push after hours with Apple, so we'll see if that can give us a little bit of positivity going into tomorrow's open. But we now have some bearish intermediate postures that we're dealing with the market forecast technical indicator. So we are in a little bit of a precarious situation. We want to see where this move takes us. Again, I'm not going to be doing the video tomorrow, but David will do a nice recap for you on Thursday. So look forward to that as well. But until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.